Hey there, everybody. Welcome back to the Finding Financial Fitness Show. I'm your host, Nino Gonzalez, joined by my co-host, Chen, and a very special guest today, Luc Larose. Luc, welcome to the show.
Thank you very much, Nino and Pei. Appreciate the opportunity to talk to you and your people.
Yeah. So as we always mention, right, we like to bring guests on that we've either learned a lot from, currently learning a lot from, or have done business with. And so Luc is with Supreme Lending, and I went through the process of refinancing a property of mine and paid it as well, successfully had it completed. Mine didn't work because, I mean, that's a whole funny story about it being uninhabitable. We give my father-in-law problems all the time for that. So it was awesome, but it was an awesome experience, a good learning experience. And so throughout the process, something that I and Pei noticed with Luc was we had a lot of questions because it was done a little bit different than the conventional financing. And so it was a lot of learning process and a learning curve. And Luc was super helpful with being able to explain that to us. So appreciate that, Luc. And that's a big reason why we wanted to have you on. So just to start off with, can you tell us a little bit about your background? What do you do? Who are you currently with? A little bit about your history as well.
Yeah, absolutely. Again, Luc Larose, mortgage loan officer with Supreme Lending. Been in the business for 25 years originating loans. Supreme Lending is a company out of Dallas. We are a national company, so it allows us to do transactions in every state. And, with that said, we do all different types of facets of loans. We do VA financing all the way to conventional, FHA, USDA financing, one-time closes, construction loans. We do reverse mortgages. So we do pretty much every type of loan out there except land loans. So only thing that we won't touch our hands on are land loans. So with that said, I'll let you move on and ask further questions. Here to help.
I just want to give a vote of confidence because in my 20 years of owning properties, I've worked with multiple, just numerous loan officers. And I can say, hands down, my experience closing my 2 loans with Luc was the smoothest, despite the challenges we had with the realtor that we were using and the selling process. Shockingly, the loan process was the smoothest, most enjoyable process that I had, hands down. Just 5 stars.
I don't think that's ever been said about a mortgage loan officer, because it's normally the other way around. It's always, oh my goodness, I don't want to, the mortgage, they ask me for all these documents, all these questions, I have to jump through all these hurdles. I got to give my firstborn baby. There's always complaints about the loan process. And we've all done it. We've all been a part of it in a process with it. So I'm glad you gave that vote of confidence, because I can say that as well. And I think, Luc, what you mentioned, some of the loans that you do, a lot of people probably haven't even heard of those. I think most people are familiar with the conventional, maybe an FHA loan, but it's good to know that there's other options out there when it comes to purchasing homes and having loans. So in terms of underwriting, because I've always been curious about underwriting, there's always something different that's asked upon. And tell me if I'm wrong, but does it depend on the loan, the documents, and the underwriting requirements?
Great question. It really has to do with the organization you have your loan application with, because a lot of institutions may have additional overlays where Supreme Lending doesn't have additional overlays where maybe another organization may have an overlay. And what that means is the underwriter having a particular type of reason to ask for additional documentation that's outside of agency guidelines. And when I say agency guidelines, I'm talking about, Fannie and Freddie guidelines that we follow by the book. That is pretty much our Bible. So if you go outside of that, like with non-conforming loans, and that's in jumbo financing, the investor has specific guidelines wanting to purchase that loan. So they're going to have additional overlays that maybe Fannie and Freddie won't have overlays. There are some certain jumbo lenders, investors out there that do follow agency guidelines, which those are the ones that we try to participate with and sell our loans to, just because it's a little easier documentation. We understand the process, understand what they need to get the borrower to the finishing line. So that's pretty much in a nutshell. Our underwriters in our organization, with where I work, it's a one-stop shop. So we know exactly what our underwriters need to get to the finishing line. And that's the most important thing, is getting to the finishing line.
So you mentioned jumbo financing. Could you explain to listeners what exactly jumbo financing is? Because I'm personally not very familiar with it as well.
So what's changed here recently is that conforming loan limits have just made a stand that they've increased their minimum loan amount to now 800,000. As of earlier in the week, the maximum loan amount for conventional financing was 766,550. They've just made Fannie and Freddie just made an announcement. They've made conforming loan limits increased to 800,000 now. So any type of loan greater than 800,000 jumps into the jumbo space. So jumbo financing is a little bit more difficult to underwrite. They may and ask for additional documentation, like maybe 3 years of tax returns if they're self-employed. They may ask for a certain amount of reserves per their guidelines. So it's a little bit more strict financing, which a lot of times lenders or loan officers will try to not have a client go into a jumbo financing if they could find creative ways to avoid doing that. And that could be either having a first lien maxed out to 800,000 and then have a second lien greater than 100,000 or 200,000, so they don't have to do a jumbo loan. So it's just a little harder financing because, like I said, they have additional overlays that may create a wedge for that borrower not to get into a property or have a difficult time to get the financing for that particular property. So that's the reason why you just have to just know your overlays, know the investor, and know your product, because it could create a problem as you move forward with the loan thinking that everything's going great, and then all of a sudden you run into a problem because their DTI doesn't meet their criteria. They're a little bit more strict. Sometimes you have a DTI, which is your debt to income. You got a front ratio. You have to meet their guidelines, that back end ratio that exceeds their guidelines. Then you got a deal there that you can't make a loan happen. So, and sometimes they may ask for anywhere from 6 months reserves to 12 months reserves. And if a borrower doesn't have that type of assets or retirement that will cover that reserve requirement, then again, you just don't have a loan. So that you just have to know which investor you're trying to sell to, just because sometimes people just try to sell rate. And that's very common in our industry and in our space, is that people just try to sell rate. But really, if you have the lowest rate, sometimes if you don't get to the closing table, that rate doesn't mean anything until you get to the closing table. So it's very important to know who you're dealing with, and you're dealing with a seasoned loan officer. It makes a big difference who you're talking to and what kind of information you're getting from that individual. Because this is, an experience that people don't get around and buying a huge investment like this. So you need to know who you're dealing with. It makes a huge difference.
And I'm actually shocked that the threshold is so low. Every house in Dallas seems to be selling at 900 plus. Everybody's doing a jumbo loan nowadays.
There's a lot of jumbo financing out there, but I tried to be creative by maybe having a first lien and a second lien. But in some cases, when you're buying a $2 or $3 million piece of property, there's just no way to avoid it. You have to do a jumbo loan, and you just got to have to know your investor. And it's very important to know where you're going to sell that loan and what their guidelines are.
So do you mostly work with investors or?
Well, Supreme Lending, we do have the opportunity to service loans. And during this hectic period in our economy, we've sold a lot of our servicing to other entities out there, like Rocket Mortgage, Loan Depot, Penny Mac. A lot of them do a lot of servicing. So we've sold our portfolio servicing book to those entities. But we do have the capacity to service a lot of the loans. We used to be very heavy in servicing. But with what's happened with inflation and with rates going up, we've sold a lot of our servicing to free up a lot of our cash. So we're not, in debt. So we're more cash happy, and we're in a very good space right now. But a lot of organizations out there have relationships with investors through like Fannie and Freddie, and we'll sell our loan once we close with Supreme Lending. We will fund under our name, Supreme Lending. And at times that we will probably sell that note anywhere from 60 to 90 days down the road. Probably has what happened with your loan.
Yeah, that happens often. And it's so interesting because just talking about the creative ways of financing. So what does the general, when you have an investor coming in that wants to buy a rental property versus a person, just a general person coming in to buy a house, what are the difference in requirements for the two typically? And I know it's case to case, but what are the general guidelines you see different?
Well, as an investor trying to buy an investment property, minimum down payment in cases, in majority of the cases, is 20% down. We could find different types of financing out there, again, being creative, as low as 15% down. But to capture a very aggressive interest rate for an investor buying an investment property that's not their primary home is typically 25% down, where they could capture a pretty good interest rate for an investment property. Now, for an individual who's trying to purchase a house as their primary home, the minimum down payment typically for conventional financing could be anywhere from 3% down to 5% down, depending on credit performance. And going into an FHA loan, which is a government loan, Federal Housing Administration loan, it's 3.5% down as a down payment. Now, if you're looking at possibly a VA loan, that is possibly one of the best loans out there in the market, is 0% down. It's 100% loan. And same goes to USDA financing. It's agricultural loan. So the property has to also qualify for USDA financing as well as the borrower. There's different guidelines for USDA financing, but still great loan. If the borrower qualifies and the property qualifies as well, it's also 0% down, 100% loan. Another great loan. But there's more layers to qualifying for a USDA loan than a VA loan. Obviously, you got to be a veteran to qualify for a VA loan. A USDA finance, and the property has to meet USDA financing. It has to fall under a rural location, usually on a census tract that's less than 100,000 people or so, but sometimes the census tract is not updated as much on their site. So you have to go to their site to see if the property falls under that census tract and the property qualifies, and then the borrower has to qualify as well. Just different layers of qualification. So you just got to have to know all the guidelines. But like how I help pay was, I do a lot of different types of financing, and I fall into a new niche the last 6+ years is doing trust income and doing loans for individuals who have irrevocable trust or revocable trust. And we've become very knowledgeable doing those types of loans and helped a lot of individuals nationally doing trust loans. And they're all under the agency loans. It's conventional financing or VA financing, or even in the jumbo space, I've done trust loans and helping individuals like pay.
It was definitely a new thing that I've never heard of when we went through that process, because I'm very familiar with VA. My husband is, a Navy veteran. So we bought multiple homes with that. And man, we had a complicated situation because we had an existing property that we had a VA loan on. We were buying a new house, and you helped me throughout that process because we were also using the trust. So it's like layer upon layer of complication. I was shocked that it didn't require a whole ton more documentations than typical loan. And actually it was fast. It was super fast. So tell us a little bit more about like how that process worked out like that.
That is a great question. I was introduced to doing trust loans from a coworker here at Supreme Lending, and he gave me information, and I just went and read the guidelines for Fannie Mae and Freddie and just looked at how we can help families and people that have these types of trusts. There's different trusts out there for different families. So I worked with a lot of people that do revocable trusts, that have revocable trusts and have irrevocable trusts. And I found an opportunity and sat down with my underwriters before I fully committed to people in my space and families before I made a mistake. And I really had to learn the process and learn how I could create a loan for these individuals, because a lot of times these individuals who have these certain trusts don't have verifiable income like W-2s or tax returns. So most of all their income is protected inside the trust. And as I read the guidelines, I got into an opportunity to talk to my underwriters and say, if I have this particular trust and I have this income and the trust is producing this income, can I use that income to qualify my borrower? And they said, yes, this is how you have to give us the documentation and show us proof of those, that documentation, show us the proof of income coming from the trust. And that's the income that we use to qualify for the borrower, and we move on. We don't have to show tax returns in our case. We don't have to show W-2s in our case. We don't have to show anything but a transaction to show that the trust is paying the borrower the income they qualified for in the loan.
So I'm going to interject here because we haven't really covered trusts on this show much, and we will. There are a lot of trust options on this show that you can learn about, and we will discover some of them, and we'll talk about them as well. But I do want to move forward with this because obviously for Pei and I, and we have community friends that have trust. The one thing I will say about trusts, because there's a lot of discussion about it, is it's very hard to make a blanket recommendation if a trust works for you and what type of trust. But there is a time, just like with any investment, there could be a time and a place for a trust. And there's a lot of things to consider when you get a trust or if you're considering getting a trust. So I wanted to put that disclaimer out there. But going back to that, on the trust loans. So when the loan is created with the trust, is the lender, is Pei responsible, or is the trust the one on the loan?
It's the grantor is the borrower that's qualified for the loan. The trust is just a vehicle producing income for the borrower. So the borrower could qualify for the loan. Now, after the loan closes, I advise my clients to push the property inside the trust so the property is protected, just like an LLC. That's how I advise and communicate to my borrowers as they talk to their CPA or their trust attorney or their accountant, is after closing, we would push the property inside the trust. We could do any type of loan through the trust as it produces income. We could do cash out refinances. We could do rate and term refinances. You can buy investment properties, all sorts of different types of financing that you could use your trust to buy these properties.
Yeah, there's so much that I could go with that because but it is very high level, and it is something that is so unconventional for the average person probably listening to this show. You're probably 2 or 3 steps removed from that. But what's good to know is that there are multiple options out there. And I think the biggest, and Luke, I think you can attest to this as well, the biggest reason why people get a trust is because they're trying to protect their assets. And we had Jordan Bingham on the show a couple episodes ago talking about what the wealthy do in terms of asset protection, and trusts tend to be up there with that. But there are legal limitations when it comes to having a trust of what you can and cannot do. And that's where someone like Luke and what he's doing can offer a unique and creative space that a lot of people just can't, because they don't take the time to do what Luke did and read and understand. And, because maybe you can have someone underwriting it, but if they don't understand it, they can get themselves and you into trouble with the mortgage as well. Right. So it's so important that you go learn how to do it correctly, and then also make sure you're working with someone who does it correctly. So I think that's really important.
Well, that's
don't go out there and get a trust just to do this, right? Like, don't put the cart before the horse type situation.
Oh, yeah. Absolutely true. 100%. You have to have a trust that it will work for you, and that's what Nino was explaining. Do your research, do your homework. Which trust would work for you, and what you're looking for you and your family, because it is a great vehicle to have to protect your assets and help pay less taxes on your income. And if you're a business owner, a lot of times business owners want to save as much money as possible on taxes. And if you're buying a lot of properties and you got a 1031 exchange and you don't want to pay taxes on that, that's where that trust plays a huge factor on saving upwards of 30-40%, and you end up maybe paying as little as 10% on that gain. There's so much to learn about it. But as we talk here, the most important thing is giving people the information that just because they are enrolled in a trust. And every time I talk to an individual that owns a trust and I explain to them how the process works, they're in awe because it's so easy and they're shocked that it works that way. I was just like, yes, I've done this for 6 years and it's been an incredible journey, blessing so many families.
Oh yeah, absolutely. So going back to, so away from kind of the trust financing means, I think that's like 5 levels removed. I think that that's great. So bringing it back to kind of rental properties that people are wanting to maybe buy, because I think the average listener will probably be in that space where they might have a rental property or considering expanding their rental property portfolio. So can you use projected rental income to help qualify for a rental property as an investment?
Yeah, you can. You could definitely use that income. And at times now there's so many products in the industry that, goodness, that you could go in and as an investor, you could do a DSCR loan, which is a debt recovery loan. So if you have a property that's already leased and the loan that you're purchasing through this product is just based off credit, FICO score performance and assets, and also the property that you're purchasing. So if an investor wants to buy multiple properties, there's no cap on this. They can buy as many properties as they want.
My understanding is like if you don't do the DSCR, if you were trying to buy properties under your own like conventional, there's a limit, right? There's a cap.
There's 10 properties.
Okay.
There's 10 properties, yeah, that state through Fannie and Freddie that you could purchase. But through the DSCR, you can buy as many properties as you can. And it's a great product if you have strong credit and you have great assets. Those are the only 2 vehicles that they really look at and make sure the property will appraise and cover the rent, that cover that debt of the cost of what the payment will be on their loan. So if they have a tenant already in that property, that's a bonus. And if they want to create a lease with a prospect that wants to rent that property prior to closing, that's also a great option for that investor. So there's some great programs out there that will help investors capture financing. And that's right now, rates are coming back down with this recent Fed cut on interest rates. Rates have dropped down, not a full 0.5%, but they've dropped down. You've seen an 1/8 to 1/4 in the last week and a half. It's a gradual process. It doesn't happen immediately, but with this recent Fed cut, we're seeing some positiveness in rates starting to lower.
And like for the DSCR, what if the property was vacant?
It's okay, because what we'll do is a 1007, which is a rent schedule. So when the appraiser goes out to the property, he'll look at different rent comps, and then he'll give us his assessment on how much the rent roll would go on that property. So once that rent roll is produced on his on the appraisal on his 1007, a standard appraisal is a 1004, and then with rent roll, rent comps is a 1007. And you always have to add a 1007 to a DSCR loan, just because you want to have to know what the rest of the community or comps are renting their properties. So they look at those 2 facets to do that loan, is the rent roll, and also if it's vacant, that's what they look at. If it's not, then they'll look at the actual lease.
When you mentioned with the DSCR, strong credit and strong assets, what are you looking at ballpark? Like strong credit being above what, 700, 720?
They could go as low as 660 on that product. Okay. But you're not going to get the best interest rate. If you're going to capture the best interest rate, you want to get 740 or greater, but you could go as low as 660. I'm doing one right now for a FICO score 680 and the rate's at 7.25. And that's not bad. If you have a strong credit, I've seen rates in the 6s for a product like that, which is great for an investor to buy investment property with 20 to 25% down.
And I learned a lot from the DSCR when Pay went through the process last year, because I was unfamiliar with it. When I initially learned about real estate, was under the impression, well, after 10, you're kind of capped out. But this just goes to show, and a big part of the reason why we wanted to have you on is just because there's so many options and there's so many ways to be creative. When Pay and I have funded fix and flip projects, and they try to go the conventional route of refinancing. They're like, well, I can only get X amount. Well, find a strategy, find somebody to work with that can help you, work in these unique categories. And so I like that. Clearly you do it. Clearly it's possible.
Yeah, it's possible, because a lot of remind people too, what they do is they go get a hard money loan, right? Sometimes they'll be fortunate enough to get a 12-month hard money loan at, a high, interest only product. And then once the property is ready to either be rented out after, 3 to 6 months after they do the necessary repairs to the property, then they go in and they have to convert that hard money loan into permanent financing. And so that's what they come in and do, is doing the DSCR loan. It's a strong product for those types of people. So either they have a renter in there, or they want to buy another property, so they'll do another DSCR loan. So it's a great product for investors out there that needs assistance and permanent financing, that may, again, not have tax returns or verifiable income. So that product is really strong for investors and people who are self-employed.
So this product has been around for a long time. Is there a chance that it might go away?
It hasn't been here for a long time, probably a few years. It's kind of like a subprime loan, but nowadays it's a non-QM loan. That's what they call them. But it's still under the same family. So at this point, they're seeing some really strong production in terms of the default ratio. It's been a positive loan for investors. So right now, there's not a lot of defaults under that type of product. So I see that program sticking for a while.
Because of the, typically with like the one that I purchased, I had to put down 25%. So if I got 25% down payment in that property,
you're not going to default.
You bet your butt I'm not letting that go.
That's right. You got a lot of skin in the game. It's not like, back in the day in 2006, 7, when the market crashes, that a lot of people are buying investment properties under an 80-20 loan or 80-15 loan, a stated income, stated asset. Those are slowly trying to come back into the market. There's a couple places doing these types of loans. I don't see that ever going to try to survive. I hate to come back from 2006 and 7 and what's happened to our economy because of these subprime loans doing these 80-20 stated income, stated asset loans. There's no skin in the game. So I do not want to have that come back in our market. But I'm hearing a little bit about it. There are some places that are selling that product, few and far between. But I don't see that surviving.
Knowing what you know now and seeing what you see with the market now currently, and being able to reflect back, what's your current assessment of the real estate market with the fact that we're maybe seeing a slow but surely a drop in interest rates? Obviously you don't have a crystal ball, but are prices going to go back up? Are prices going to go down? Is there going to be an adjustment? And we hear these things all the time. So from your perspective.
That's a great question. Now, I don't have a crystal ball, but usually during this time of the year, during election time, we usually see a small dip in interest rates. It's cyclical. You look at the 50-year average, it goes down typically during this time, first quarter. Next year, we're going to see, again, some improvement in interest rates. That's what I've been hearing in the streets. That's what I've been following and reading every day. Economists telling us, be patient, float the rate, allow it to come back down. And when a lot of the people are telling us typically is to lock in the rate right about 15 days prior to closing, let it float. But I see that there's a lot of inventory in the market, which is great, allowing buyers come back into the market to purchase property, and rates are coming back down where people are now affording property because rates are starting to come back down. I don't see it coming back down as it was during the COVID years in the 2s and the 3s, but I see them coming back down in the 5s and maybe high 4s. So that's positive.
We can live with high 4s.
Yeah. We're spoiled during that time.
Yeah,
I'm waiting in the wings for the rate to drop to refi too.
Well, and that was going to be my next question, because this is something that I have personally encountered in people that I talk to, that let's say someone has bought in 2016, 2017, 2018. They are sitting in equity on that home right now. But the number one thing people say is, well, why would I refinance my 2.8% loan when rates are at 7.5%, but I'm sitting on 200K equity. And Luke, I see you shaking your head. Talk to me about
I'm
this.
telling you, these are the two things I battle every day. Is people trying to get that equity out of their house and doing a HELOC loan, which is a line of credit, and it's a second lien that's attached to their mortgage, and they don't want to touch that first thing because of that low interest rate in a 2 or in a 3%. I battle that all the time because they still have to qualify for that HELOC loan. It's a line of credit typically that's a rate that's floating in the 7s to 9, depending on credit. But it's having that money available for a rainy day, or if they want to have a home improvement, they could tap into that line of credit. It's a great product. It's there. It's available. I'm dealing with a lot of people also, as well as doing a rate and term refinance. The last 2 years, it's been really painful in our market, but people still have to buy houses. So you're having people in the high 6s, low 7s, and that's what I'm doing a lot right now with those people. Is I'm going back to my clients, advising them, consulting them to just hold off a little bit right now. We're not quite there. Typically, you want to see a good point and a half rate reduction from their current rate to really feel like it's a good return on their investment when they do a refinance. That's pretty much
explain a little bit? Can you explain a little bit about the rate? Is it called the rate in term?
Yeah, it's a rate in term refinance. Is just basically getting them out of their current high interest rate to a little bit lower interest rate, and possibly maybe taking equity out of that property as well. During that time, people bought property, some a little high, so there could be not some equity in there, but some people may have put 10 or 20% down where maybe the property has increased in value. Those people may have an opportunity to take equity out of their house. But in other cases, people want to get into a lower monthly payment on their house. So it's coming to a place where now rate and term refinances are becoming a little bit busier in the market right now. People are trying to get into a lower interest rate to lower their payment, and that's happening as we speak right now. And I'm dealing with a lot of those clients, making a lot of phone calls, talking to them about this is a good time to possibly jump in there and do a rate and term refinance to drop their monthly payment. The norm, like I mentioned, you definitely would like to see at least a 1.5 point improvement to their rate. So if they're at 6.5, you want to be at least 5%, or if they're at 7%, you want to be about 5.5%. We're not there, but very close. Some people, they say, if I could save $300, we'll only see a 1% rate improvement. Maybe the rate will improve again in another 6 months, 12 months, and we can do another refinance. And that happens often too.
Again, having that conversation with people about, I know, Pei, you had mentioned this, with your previous home, if there's equity in the home and they have a really, really low interest rate on it. And we were just talking about in our previous episode about whether or not to pay off a mortgage. And for some people, it's an emotional decision and they want to pay off their mortgage. For others, they want to use that money, maybe invest it. But for those that are in the camp of wanting to basically have no mortgage and doing essentially a cash out refinance where they can get out their equity, let's say they have $200,000 in equity and they have a $200,000 mortgage. Would it make sense or be advantageous to spike the rates to go refinance, get that equity out, and then use that equity to pay off their mortgage and then now have no mortgage?
Yeah. They could do that too. There's definitely, depending on what your situation is and how you look at what they have, maybe has revolving debt that has higher interest. That's what a lot of times people do because they've been living off their credit cards. I mean, a lot of people in today's world, they have a lot of credit card debt. They've been, having a hard time paying those debts. So in cases, I've refinanced and taken equity out of their first lien and just did a complete cash out loan on their total loan and not do a HELOC or a line of credit, just because we needed to get all that cash out immediately and pay off debt so we could secure themselves from not having an overhead of high interest rates on credit card debt. So again, every situation is totally different to every family's needs and wants. And that's the reason why when we first initially talk to that individual, we find out what their needs are and we discuss what's the best option for them. So if it's doing a cash out or doing a HELOC, we figure out what is the best option for them and their family, and we move forward with that loan program.
Yeah. So many opportunities, like so many. Yeah. Hey, were you? I know you had a question.
I forgot already. That's okay. Well, maybe no. I should say Luke already answered it.
It's gonna come up. It's gonna come up. And you're I like the fact that as a mortgage loan officer, you're willing to sit down and have the conversation with people, as opposed to, because as you very well know, it's not a cookie cutter option. It's not a do this or do that. And the fact that you understand, I mean, just I don't know of many mortgage loan officers that would use the knowledge of being able to use cheaper debt to buy off more expensive debt. I mean, we talked about this on the show multiple times when it comes to velocity banking and how we can use that money potentially as a line of credit to invest, or use the line of credit to pay off a more expensive debt and then pay back the line of credit associated with the home. The fact that you have that knowledge allows the person that's meeting with you, the buyer or the potential seller, to have their options laid out on the table. And that another reason why I wanted to have Luc on is just so people can realize what a good mortgage loan officer can do. So if yours isn't potentially doing this, well, maybe it's time to reconsider, because it gives you, the more tools you have in your tool belt, the more options you have, the better you can find what fits for you. Right, Pei?
Yeah, I think that a good mortgage officer in your pocket is, it's part of your team, right? We talked about, actually way back, we talked about building a team to surround yourself with, right? And people often overlook the mortgage officer in that corner, because Luc, you play a part in even like my, the credit piece, right? Because I was trying to actually reach out, trying to do a refinance, and he was like, okay, you got to pay this down just by another $300 so that we can get that credit to the next level, so that you can get a lower rate, right? So that piece of experience and advice can save you thousands of dollars, right? That alone was like, okay, hold on, then let me just take care of this and then I'll proceed, versus someone who's not in your corner and just wants to close on the loan would be like, yeah, go ahead. Let's just use today's, FICO score and get whatever we can get and close you out. So he's looking out for my interests. And that's why whenever I have a loan, I call him first.
I appreciate that very much. So that's exactly what you have to do as a loan officer. And the tenure that I've had, I think the most important thing is I care about people. And that's the most important thing that I have in my corner, is that the way I was raised and the way I care about people is I look at their situation as if it was my situation. So, and that's the key thing, is that when you consult and you share things with them and they understand, and I try to make it as easy and simple as possible, and take a lot of time to having that communication and re-emphasis about the things that are important, that we can make that next step together. And just as I explained to you, in your situation, if we do this small thing, you're going to see, and you're going to reap the benefits with a much lower interest rate. And it could be a quarter to 3/8 difference in rate from a 700 score to a 740 score. So it's makes a big impact by doing just one small thing. And it doesn't take a lot of time to communicate that to someone, and to make things a lot easier for them and their family, when the payment's a lot cheaper than if you didn't do that. So it makes a big impact. It makes me happy when you're happy, and it makes the world go round.
Well, and also, I mean, there's something to be said about the fact that you can have someone can call you and say, hey, I'm thinking about doing this, and have the conversation and at least get some education on what they could potentially do. And that's nice to be able to have that. And I remember when I first bought my house, it was go get some quotes, go talk to different, loan officers, but never did I have the conversation. It was always about, like you said, it was always about rates. That was rate focused. Okay, well, we can lower your rate by, this percentage or this amount. That mortgage company is not good, but they never asked me about, well, why do you want a lower rate? But what if you do this, and this? That's naturally going to get you a lower rate. So I think that it's very important to have people in your corner, specifically because, like we mentioned on our last show, you're going to live somewhere. Whether you rent a home, buy a home, have rental properties, you're going to be around real estate. And there's a reason why real estate has been the number one asset class for most investors. And it's always evolving. It's always changing. And unless you want to do the research and learn about and stay up to date with everything that's currently going on, it's good to have a loan officer that you can pick up the phone and say, hey, I'm thinking about buying this property. What are your thoughts? And that's the relationship that we have with Luc now. And sometimes in Pei's case, it works out. And sometimes in my case, it didn't. And that's just the nature of it. And to be fair, in my case, it was a very unique case because my
Yeah,
father-in-law
tell them
lives.
about that. It was not a livable space.
It was.
It's the
Okay,
only reason why we couldn't make the loan happen. The
it was.
loan was clear to close. It's just the property wasn't livable.
My father-in-law lives in North Houston, so about in Livingston, about an hour north of us. And so he bought what's known as a barn dominium. So barn dominiums are very common in Texas. And so he bought one. It's basically where it's just a big metal shed, if you will. But he built a tiny home within it. So there's a tiny home where he lives, but then right inside that big barn is still he has his cars where he can work as a mechanic on them. And so he lives in this tiny little section. Well, called Luke, because he had paid cash for this 2017 or 2020 it was actually. And of course the property appraised a lot in value. And I said, let's get some cash out of that property. It's just sitting there. So I told Luke, we went through the whole process. Everything got approved. He sent out an a few appraisers, and they came back and had said, this home is uninhabitable. And I told my father, I was like, hey, are you living there? Because apparently no one can live here. Like, this is not a safe place for someone to live.
Oh,
It's a
we tried
hobbit
so
dwelling.
hard. We tried so hard. We brought so many people to go there and evaluate and remeasure. We just could not find any space that was livable. So that was the end, unfortunately. We tried. We put a lot of time and effort into that deal.
And there was multiple appraisers that came out. And,
for
me, it was a big learning experience. And a lot of it had to do with the comps, because this was in an area where there was a lot of homes that were either like RV hookup homes or they were actually built homes, but it was essentially subdivided lots where you can just buy a lot and decide whatever you want to do with that lot. And so comps, there was no comps that were ever even similar to it. So again, I learned a lot about that process, about, what to do and what not to do. And because, like Luke mentioned, not, touching land loans, that obviously has its own issues as well. So it was a fun experience. I was picking up, the phone, talking to Luke, and to this day, I think when that was all happening, we were in Europe trying to make this all work. And we're like, hey, can we have someone go out to the property? It was definitely a fun experience, but I don't know if any property that I don't think Luke could do. And this wasn't even a Luke problem. This was just the fact that none of these appraisers were able to just say, hey, someone lives here or can live here.
Yeah. That was the first learning curve I've ever heard or come across a property that wasn't livable. I was just like, oh goodness. I felt so bad for Nino, because we put so much, like you said, you're in Europe. I was trying to get so many different people out there to look at this property, and took so many sketches and pictures, and I was like, I don't know how this could work. Unfortunately, things do happen for a reason, and you got me introduced to Pay, and
and I remember just seeing how hard you were working on it and how willing you were just to have the conversation. And I know, although we didn't close that home, I know for a fact the next property that I buy, or the next couple ones, we're going to be involved in that, and we're going to have that conversation. And it got me to know you a little bit more. So we talked about a lot today. I know that we dove right into, like, I didn't know about jumbo financing. I didn't know much about how the trust financing worked. So, and again, for some people, maybe they're not looking at buying a $900,000 home. So maybe jumbo financing doesn't apply to them. But as we naturally progress in our investment journey, and people that are here are on their investment journey, there will be a time where you're in that path, or maybe you do get a trust, or maybe you have a home that you just bought last year and you're looking at doing a rate and term finance, which is what we learned about today. I think my biggest takeaway was, one, there's so many options out there, but those options don't mean anything if you don't have the right mortgage loan officer behind them knowing how to talk to you about those options. So I learned a lot today. Pay, do you want to kind of wrap up? Do you have anything you want to follow up on?
Again, today is all learning. We talked about this before we started recording, because Luke was dove right in. And so thank you so much. I mean, we talked about, borrowing somebody else's time. So we're leaning on Luke's 25 years of experience in this industry. So we appreciate it, so that we don't have to spend 25 years of learning. So thank you so much.
Thank you. It's an honor.
Everybody, thanks again for tuning in. We hope you guys got value. Luke, thank you again for being on. Maybe we'll, have you back on a few months' time, a year's time, after we've done a few more deals and learned a little bit more, and we can dive a little bit deeper as people and as the show gets more advanced. So once again, Pay, thanks for being on, Luke, and thank you as well.
Thank you.
You.
Yes. Have a great weekend.